Hello, it's Wednesday, August 16th, 2017. I'm Steve Houston with Compass Communications, and I'm again here with Joe Terril of Terril and Company. And Joe, we're going to talk a little bit about markets and the investing and the economy.
Let's do it.
Okay. Everybody is excited about the Dow. It's north of 20,000 and people are piling in, and it seems like there is no end to where it can go. But what do you think?
Steve, I've taken the opposite track. We are in one of those time frames of a lot of speculation where people are not really investing. What they're doing is playing momentum. They are buying the high cap tech stocks that are already grossly overvalued because they see them going up and they believe they'll go higher. They're buying 2 or 3 of the Dow stocks that have been moving. When you separate some of these things, for instance, you realize 60% of the move in the Dow Jones Industrial Average is coming from just 3 stocks. You take out the big cap tech stock names, and instead of the NASDAQ being up 15%, it's only up 5%. You begin to realize just how narrow the market has been. If you haven't been chasing momentum by buying what's high in price, hoping it's going to go even higher in price, you're up 4 to 5%. So I think the message there for our viewers is this is not the runaway bull market that it appears to be. The last 17 new highs in the Dow Jones Industrial Average only moved the average 2.25%. That's not a runaway bull market, and this market right now is fraught with risk.
Okay. Well, you and I were talking before we started taping about some comments that former Fed Chairman Alan Greenspan had made, and I just want to read them a little bit. When interest rates move higher, they are likely to move reasonably fast. We are experiencing a bubble, not in stock prices, but in bond prices. This is not discounted in the market. What's he telling us here?
I wholeheartedly agree, and in some ways when he made those comments, now it's been 10 days ago, 2 weeks ago, I felt this way for the last 6 months. And so far there's been no rapid increase in interest rates, so we're wrong. If you could get the timing exactly right, you could be a multi-millionaire. But I do believe, and was comforted to see somebody with the credibility of an Alan Greenspan agrees with our position. Interest rates around the world are being held artificially low by central banks. They are very close to the point where they can no longer do that. When central banks can no longer hold the interest rates down, they're going to go up quickly. I disagree a little bit when he says not a bubble in stocks. When interest rates go back up, it's going to create a general revaluation of the entire stock market. Said maybe in a more simplistic say, we've been in a 5 or 6 year period called TINA. There is no alternative. As interest rates go back up to 3 or 4% around the world, there will be alternatives to stocks, and future earnings, future dividends, and etc. that are discounted at an interest rate to determine what you think stocks are worth. If you have to use a higher interest rate to discount future earnings, dividends, etc., you come back with a much lower price for stocks. So I'm really worried that the market has become so complacent, stock market that is, let alone the bond market, that people think nothing can go wrong, nothing can happen, nothing will change, and these prices are just going to do this. No, I think we're in the final stages of a bull market that started basically in April of 2009, and when it ends, it isn't going to end pretty.
Sounds like something we've heard before. So how are you positioning your portfolio?
Trying to be very defensive. We're holding a lot of very short-term fixed income products that will not go down in value when interest rates go back up. The bond market bubble and et cetera that he's talking about is if you have any type of duration maturity. you could sit there 8, 9 years trying to wait to get even. We're avoiding that by accepting a lower rate of return, and it's very difficult to do in today's world where you want to try and make as much as you can. But that's the cost of saying, I'm going to stay out of harm's way, and I'm not going to stick my neck out for something that's all risk and very little reward. So one of the things we're doing in portfolios, keeping all the maturities extremely short. Some of it we're buying floating rate paper, so higher interest rates actually helps us. And the other thing we're doing is we're not chasing the glamour stocks with the expectation that the stock that's already grossly overvalued can go even higher in price. There are not a lot of good bargains out there right now. We like the financial stocks because higher interest rates actually are good for banks. And we have a few select things. But the real answer is we're a much better seller at all-time record high prices than we are a buyer.
Okay. Well, that's about all the time we have right now. Once again, I'm Steve Houston with Compass Communications, and I've been visiting with Joe Terril of Terril and Company with $725 million in discretionary assets under management. Joe, as always, it's been enlightening, and let's chat in the fall.
Hope so, or maybe we'll talk off camera before that.
Okay. Thank you very much.